Hello fellow human, nobody here with a new stock analysis. Should you buy Rivian shares? As always, I will jump straight into my verdict and I will give you my reasons afterward. Let's go. At today's price of $14.6, Rivian is a sell. I will not give you a price target today because I don't have one. Turns out it's quite hard to assign any value to a stock when the profitability of the underlying company is underwater and land is nowhere to be seen. Before we go any further, if you are emotionally attached to the stock and are just seeking opinions that reinforce your pre-existing beliefs, honestly, this is not the video for you. Otherwise, I hope you enjoy the video. And if you find value here, please like it and subscribe to the channel to be notified of future content. It helps immensely. With that out of the way, let me explain the reasons for my pessimism about Rivian. But first, a little disclaimer. If you're watching this, I assume you're not a lemming, but a sovereign individual. Nobody can tell you what to do with your own money. I only provide you the tools to take financial matters into your own hands. You alone are responsible for where you place your time and money and trust. So no, this is not financial advice. This is just how nobody invests. Rivian is an electric vehicle company founded in California in 2009. It designs, manufactures and sells electric pickup trucks and SUVs. Its flagship models include the R1T electric pickup truck and the R1S electric SUV. They are both designed for on-road and off-road use. They also sell electric delivery vans to Amazon as part of an agreement between the two companies signed in 2019. Amazon is committed to purchase 100,000 vans from Rivian until 2030, of which 10% have been delivered so far. In 2026, Rivian expects to begin production on its new models of trucks and SUVs, the R2 and the R3 series. The R2 will be smaller and more affordable than the R1, and the R3 will be even smaller and more affordable than the R2. The goal is to increase the volume of sales and be able to scale up operations significantly through cheaper offerings. In my opinion, and I don't think it's a very controversial one, Rivian's cars are beautiful, both modern and classy at the same time. I think they are designed with excellent taste. In fact, the company seems to have wanted to be number one out of the gate, which strikes me as the opposite strategy of what auto manufacturers did in Japan and South Korea decades ago. The Asian tigers started out modest, offering cars that were simple and cheap by Western standards. But it worked out pretty well for them in the long run. Brands like Toyota, Honda, Hyundai or Kia just had to endure being laughed at for a while. But who's laughing now? Rivian, on the other hand, wouldn't have any of that, and their first models are already premium quality. But perhaps they aimed too high too soon. High standards are expensive, and expensive means cash burn. The company had $2.3 billion at the end of 2019, and went on increasing that amount through 2020 and 2021. And then on November 10th, 2021, bam, they went public, raising a whopping $12 billion. By the end of 2021, they had $18.1 billion of cash on hand. Clearly, investors saw a promising opportunity and jumped at it, even though the company barely made any money before 2022, which, to be fair, is not really uncommon. The goal of the IPO is precisely to raise the funds to be able to build infrastructure to make the product. The thing is, the company burned through its cash reserves so fast, using up $6.6 billion in 2022 and $3.7 billion in 2023. That is about 1/3 of the reserves each year. If that wasn't scary enough, just in the first quarter of 2024, they burned through $1.9 billion, reducing their cash by 24% in just 3 months. Rivian has burned on average $1.4 billion per quarter since the IPO. A continuation of this trend would imply that the company has enough cash to survive little more than a year. And even if we optimistically round it down to $1 billion per quarter, the current reserves will last it no more than 1.5 years. Right now, Rivian is losing almost $39,000 per vehicle sold. And yet, the company expects a positive gross margin by the end of the year. They aim to go from a gross margin of -41% to positive in half a year. How that is remotely possible is beyond me. And really, other than their own common sense, investors just have the management's word to rely on. Last time I checked, that was not a sound basis for any investment. Look, I'm sure Rivian is doing an excellent job at reducing expenses. They are retooling their facilities, simplifying the design of the vehicles, and streamlining the manufacturing process. All great stuff, but again, it needs to happen so fast, it's hard to have high hopes. Enter the Germans. At the end of June, Volkswagen announced it would be investing up to $5 billion in Rivian. Only $1 billion initially, and then the remaining $4 billion through 2025 and 2026 as part of a joint venture between the two companies. How the math works for this modest cash injection to be enough to save Rivian is anyone's guess. In my book, Rivian might now have enough cash to reach 2026 in the best case scenario. It's also worth pointing out that given the increasingly desperate situation that the company was finding itself in, it can be reasonably assumed that the deal with Volkswagen was signed under unequal terms. In exchange for the cash lifeboat, Rivian is giving Volkswagen access to some of its intellectual property, such as the software it has developed for its cars. But let's ignore that. In fact, let's assume that the margin improvement goals are achieved and that the cash reserves are not depleted. Now what? As Rivian can tell you, the automotive industry is extremely capital intensive. It takes a lot of money to get operations up, and it takes a lot of money to keep them running. And that doesn't change the moment your gross profit margin becomes positive. Best case scenario, Rivian will succeed in staying alive in an industry with crazily intense competition and very low margins. Low margins make for poor investments because stocks follow earnings, and low margins result in small and unreliable earnings. And most importantly, low margins mean the company is never financially safe, as a few mistakes might end up in bankruptcy. Regarding valuation, the forward price-to-sales ratio is 3. It's not cheap, but it's not insanely high either for a company that is supposed to more than double revenues in the next 2 years. So, for anyone believing that margins will become positive soon, valuation is okay. To sum up, I personally wouldn't hold Rivian shares right now, as the company will either go bankrupt or operate in an industry with very low margins. Could the share price increase tenfold from here? Sure, it might. But betting on every single thing going perfectly is just gambling. At the end of the day, it's not that Rivian is the single worst stock to own. It's that there are literally hundreds of much better ones. Stay tuned for those. If you found this video only my live setting, please like it and subscribe to the channel for more. Share your thoughts in the comment section and let me know which stocks and concepts you would like me to explore in the future. If you have any questions, just ask. And until the next one, remember, if nobody invests, so should you.